Imagine waking up tomorrow and hearing three words: we can't pay. Not a company, not a person, a country. At first, it sounds like a giant accounting problem. A government owes money. The government misses a payment. End of story. But a sovereign default is not the same thing as a normal bankruptcy. There is no global bankruptcy court that simply takes a country's assets, sells everything, and hands the money to creditors. Instead, something much messier begins. Investors panic. Banks get nervous. The country's currency can come under pressure. And suddenly, a problem that started on a government balance sheet can move into the everyday economy. So what actually happens? Let's follow the chain reaction. First, we need to understand what default really means. A country can borrow by selling government bonds or taking other loans. Investors buy those promises because they expect interest and eventually their principal back. If the government cannot, or chooses not to, honor the original payment terms, it can enter default or a restructuring process. And here's the important part. Default does not always mean the country has literally run out of every dollar. Sometimes the government is facing a liquidity problem. Sometimes the debt has become unsustainable. Sometimes the country has lost access to new financing. And sometimes a political or economic shock pushes an already fragile system over the edge. Now imagine the first missed payment. The government says we need more time. Creditors hear something very different. This borrower is risky. That changes the price of the country's debt. Investors demand higher interest rates to lend again, and that creates a nasty feedback loop. The government already has trouble paying. Now borrowing becomes even more expensive, so refinancing becomes harder, and the original debt problem gets bigger. Then comes the currency. Suppose investors believe a country's economy is weakening. Some may try to move money into safer assets or foreign currencies. That can put pressure on the local currency. If the currency falls sharply, imports become more expensive. Think about fuel, medicine, machinery, electronics, food that depends on imported inputs. A weaker currency does not automatically create hyperinflation, but it can make inflation pressures much worse, especially when a country relies heavily on imports. And there is another problem. Some governments and companies borrow in foreign currencies. If the local currency falls, those foreign currency debts become harder to repay in local money. So the currency crisis can make the debt crisis even worse. Now look at the banks. This is where the story can become much more serious. Banks often hold government bonds. Those bonds are normally treated as financial assets. But if investors suddenly believe the government may not repay in full, the market value of those bonds can fall. The bank now has a problem. Its assets are worth less. If the decline is large enough, bank capital can come under pressure. And if people become afraid that banks are in trouble, some depositors may try to withdraw money. That can create a bank run. Notice what happened. The original problem was government debt. Now the banking system is involved. And once banks become cautious, they may lend less. A business that wanted to build a factory may not get financing. A small company may struggle to renew its credit line. Consumers may face tighter lending conditions. Investment falls. Economic activity slows. And the government may collect less tax revenue because the economy is weaker. Which creates another problem. Less tax revenue means even less fiscal room. The cycle feeds itself. But there is another side of the default story. What happens to the people and institutions that own the government's debt? It depends. Some creditors may receive the full amount. Others may have to accept longer maturities, lower interest,
or a smaller principal amount. This is called restructuring. There is no single universal formula. The government negotiates with creditors, and the final deal depends on the country's circumstances, the type of debt, the legal contracts, and the creditors involved. And this is where international institutions can enter the picture. A country in severe debt distress may seek help from institutions such as the IMF. But an IMF program is not simply a magic check that makes the debt disappear. Support can involve financing, economic reforms, fiscal adjustments, and a plan for restoring debt sustainability. If the debt is judged unsustainable, restructuring may also be part of the process. The goal is to make the country's finances viable again.
So does a default mean the country becomes bankrupt? Not exactly. A country does not disappear, its people don't stop working, businesses don't vanish overnight. The government still collects taxes, it still spends money. The economy still produces goods and services. But the country's access to credit can become much more difficult and expensive, and that matters because governments borrow for a reason. They may need to finance infrastructure, respond to recessions, pay for public services, or roll over old debt. If lenders stop trusting the government, all of those decisions become harder. History gives us some dramatic examples. Argentina's crisis around 2001 involved sovereign default, banking stress, deposit restrictions, and a major currency crisis. Greece's debt crisis later became one of the defining financial stories of the euro area, and many other countries have experienced restructurings without following exactly the same path. That's the key lesson. There is no single default sequence. The outcome depends on how much debt exists, who owns it, what currency it is denominated in, the strength of the banks, foreign exchange reserves, the country's institutions, and how quickly creditors and policymakers reach an agreement. And there is one thing people often misunderstand. A country does not need to reach $0 in its bank account before a crisis can happen. The real issue is confidence and sustainability. If lenders believe a government can repay, it may continue refinancing large amounts of debt. But if confidence collapses, refinancing can suddenly become extremely expensive or disappear. That's why debt crises can seem to happen overnight, even after years of buildup. So what is the endgame? Usually, some combination of adjustment, financing, restructuring, economic recovery, or inflation and currency adjustment helps bring the system back toward balance. But the process can be painful. Investment can fall, credit can shrink, output can decline, unemployment can rise, prices can increase, especially after currency depreciation. And the longer the crisis lasts, the harder it can be to restore confidence. The surprising part is that a sovereign default is not really a story about a country refusing to pay one bill. It is a story about trust. Government debt is a promise. Banks build balance sheets around financial assets. Investors price risk around those promises. Businesses make plans based on access to credit. Households depend on stable prices, jobs, and banking systems. When trust in the government's ability to honor its debt breaks, the effects can travel through all of those connections. So the next time you hear a country is about to default, don't imagine a giant vault becoming empty. Imagine a chain reaction. Higher borrowing costs, capital leaving, currency pressure, bank stress, less credit, weaker investment, lower growth, and finally, a difficult negotiation over who absorbs the losses. Because when a country stops paying its debt, the bill doesn't simply disappear. Someone has to absorb the economic cost. And the real question is not, does the debt vanish? It's,
who takes the hit, and how does the country rebuild trust afterward? That's what makes sovereign debt one of the most important stories in finance.